Oh, hello everyone. It's Susie again from Esoteric Trading Solutions. I hope you're all well. I hope you're looking after yourself, particularly looking after your parents, your mum and dad, your sisters, all your family, looking after your beautiful animals, your beautiful cats, your beautiful dogs, looking after the fauna, looking after the environment, and just being kind to people in this world as this world gets harder and harder, just to make this world a better place. Today, I've mentioned this fellow before, Alistair McLeod. He's a terrific writer. I don't know his background, but gosh, he writes some really clever things, I have to say. He's from goldmoney.com. And again, he's basically saying that will COVID-19 lead to a gold standard? I'll put the link in below on the research thing for YouTube on the detail. But he's also saying there's an imminent collapse coming in equity markets. And I do believe this myself. This is not financial advice. This is for your education only, but I certainly believe this myself, and I'm positioning myself accordingly. It just makes a lot of sense to me. We've seen the equity market literally from '09, US equity market particularly, go up parabolic. On every measure that I look at for myself, I believe the equity market is just so overboard and so expensive. It's a joke, given what's happening globally in the world. Okay, that's my personal opinion, but it's not, meant for you guys to do whatever you want to do. I'm not giving you financial advice. It's just, I don't know your risk or anything like that. This is just education only. But this article is a particularly good one, and let's go through this article because Alistair McLeod is a very, very good writer. So he basically starts with, even though before coronavirus sprang up, there was an unprepared China. The credit cycle was tipping the world into recession. Now, China's huge, as you know. It does a lot of exports. Australia certainly depends a lot on tourism from China and buying our goods as well. Certainly Asia does. So we're going to feel it more than anyone in Asia, as well as Australia, definitely, with a China that's slowing down quite dramatically. So this fellow says the coronavirus makes an existing solution immeasurably worse, shutting down China and disrupting the global supply chains to the point where large swaths of global production simply cease, which, when large swaths of global production stop, it means that there's no growth in the economy, no growth in the world economy, and it just means a gross domestic product for China and other countries is just going to go lower and lower and lower, which is not a great story because, as you know, to make it simple, without growth, you have no employment growth. And without employment, you have no consumer spend. And particularly if an economy is reliant on employment, say like the US, 70% is consumer spend, or another country, then if consumers don't have employment, they can't spend any money. And that just slows down everything, okay? And it's a chicken and egg thing. No spending slows down growth. People get put off and all these sort of things. So it goes on to say the crisis is likely to be a wake-up call for complacent investors who are content to buy benchmark bonds issued by bankrupt governments at wildly excessive prices. And clearly, a lot of government bond curves out there, some of them are still negative interest rate in the long end, and they're still at all-time lows compared to where bonds have been over, the last 20 or 25 years. A recession turned by the coronavirus into a fathomless slump will lead to a synchronized explosion of debt issuance for which there are no genuine buyers and can only be monetized. So he goes on to say the adjustment to reality will be catastrophic for government finances and their currencies. This article explains why the collapse in overpriced financial assets and fiat currency is likely to be rapid, perhaps giving ordinary people in some jurisdiction an early prospect of a return to gold and silver as circulating money. Now, interestingly enough, we have seen gold literally, it went through 1580 US very quickly, and I think it's still at about now it's at 1640. If you look at gold on a chart, it looks like it's going back to its all-time highs, which I think was about near 2,000 US dollars, okay? Also, there is some examples where governments are starting to buy more and more gold. Okay, and we can see that in China, we can see that in India, and we can see that in Russia. People are starting to go back to gold. There was even some talk that President Trump was talking about doing some sort of, maybe digital cryptocurrency asset or digital currency against the gold standard, which it used to be like that, with the UK, empire, if you want to call it that, in the olden days. So this goes on to say, my last article suggests that both financial assets and currencies would collapse together. The base of this supposition is twofold. First, central bank policies are binding together the rise in financial instruments, mass assets, with the maintenance of value in fiat currency. Therefore, if one falls, they both fall. And secondly, this is a historical precedent for which one examines the Mississippi bubble 300 years ago. So what he's saying is, if people are long or they've overbought US equities like they have, and they've done it globally all over the world as well as the US themselves, the US investors, then once they start selling those US investors, US equities, you start selling US dollars. Because me as an Australian, if I buy US dollar equities, I have to sell my Aussie dollars and I have to buy US dollars, right? To buy US dollar equities. So I get a great gain in that, but as the market keeps coming off, I have exposure to the US dollar and I have exposure to US equities, right? So if the US market starts coming off, we are starting to see that. And technically it's starting to look very negative to me, the S&P 500 and the Dow, then I'm going to start selling US dollars and US equities because I'm long US dollars as well. So if I sell my US dollar equities, I'm not going to sit in US dollars. I'm actually going to go back to my own currency, which is Australian dollars, okay? So that's what happens. When you start selling a US equity market, you also start selling US dollars, okay? And that's pretty much what this fellow is saying. I don't know about the Mississippi bubble 300 years ago, but it must have been something fairly similar. But he does say the timing for much of a collapse appears to be imminent. Every day, more and more data confirms the global economy is sliding into recession. So far, people have been ignoring this, particularly the equity market, but it's getting harder and harder to ignore. No doubt the coronavirus will be blamed. This is a mistake because the factors leading to a slump, principally the end of the expansionary credit cycle, combined with trade protectionism against Chinese imports by President Trump, echo developments leading up to the Wall Street crash in October 1929. If that point is accepted, then clearly the world could be on the edge of a very deep slump, exacerbated but not caused by the virus. So what he's saying is the conditions were already there before the coronavirus came forth. And the coronavirus is going to add to the conditions even worse because, growth is going to fall off a cliff because of the coronavirus, okay? So what Alison McLeod is saying, the conditions for Wall Street to come down very fast and for high yield debt to come down very fast and for yields to go up is already there. Also, you've heard me in other YouTube saying, inflation is not where the statisticians are telling us, the governments. It is absolute garbology. As I said, the cost of living has skyrocketed everywhere in the last 20 years. Everywhere. And inflation is not running at 2.5%. The reality is inflation is probably running at 15 or 20%. And that's why we're seeing gold go up dramatically. And also we should be seeing interest rates, yields going up dramatically. Yields going up more than obviously than yields going down. Now we're starting to see that. We've seen that the repo rate, it was like under 1%, and all of a sudden it's a 10 or 12 or 15%. Now we've had HSBC come out. They're going to get rid of 35,000 people, employees globally, and their business overdraft rate, which they had about 19%, they've now declared they're going to increase that to 40%. So already we are starting to see interest rates go up. And when they're going up, they're not going up in little increments of 25 basis points or 1%. They're going up in increments of, 10% or 20%, as you can see with the HSBC bank over rate. So we can't dismiss this, guys. I mean, this is really, something's going on when we look at the prices of certain, commodities like gold, for example, and even silver. When we look at the pricing of interest rates and we look at world growth and when we look at CPI, it all is leading to what we saw pre-October 1929. I have to say, I have done a lot of study on pre-October 1929, and this fellow, Mr. McLeod from Gold Money, is spot on the button with this, because seriously, the conditions are there, and I just think it's a matter of time before, yes, we do see absolute weakness in the US dollar against the yen, but also the equity market coming off very, very dramatically. I tend to agree with this fellow very much so. So, notwithstanding, the corona, gosh, I had trouble saying that, coronavirus, it's literally closed down China's economy, and it threatens to become a pandemic. Now, I spoke to one of my clients who's, does all this thing. He looks at, all these viruses, and, I spoke to him about 4 weeks ago, and he said it's a pandemic. I put something on my Slack today that, I got from Twitter, that a Chinese person that went to New York, says there's more like 3 million people that have coronavirus, and 250,000 people have lost their lives from it, and that the figures that the Chinese government bring out are highly understated. Now, that's a worry. If that's true, maybe it's not true, but I sort of believe the latter, that it might be. And also, one young fellow who's in his 30s or something was being treated for coronavirus and then end up back in hospital again, being treated for it again, which sort of tells you the immunity of this virus is not there. If you get it and you're not immune to it, you still can get it again. Plus the incubation period is like 42 days or something, which is a bit scary. But coupled with that, on top of what's already happening, it is a bit of a scary moment. And, this fellow also says, Mr. McLeod, that, government yields and interest rates have nowhere to go but up. And I do believe that. He said the central issue following from upcoming monetary crisis centres on the ratings of government debt. Almost all welfare-driven states are in debt traps. They think price inflation is under control because their colleagues in the statistic departments tell them so, allowing them to continue running increasing budgets deficits with apparent immunity. Now, it's the same anywhere in the world. The debt ceiling has been raised and raised and raised, and particularly in the US, where the debt ceiling has been raised to such a level that the US keeps borrowing from the rest of the world. Every other company in the G7 countries particularly are under the same problem. It's not just the US, it's the European Central Bank, it's Greece, it's Japan, it's Italy, who's the third largest bond member in the, has the third largest bond market in the world. Everyone's running a deficit, even Australia. I haven't looked at their deficit figures recently, but I suspect they're doing the same thing. So central banks do not realise that they will soon, very soon, will be the only buyer of their government debt, which they will pay for with newly minted money. Now, the problem is if you don't have anyone to buy your debt, you're going to have no one to sell it to, right? And look at it this way. The Chinese and the Japanese buy US debt. Now, if those guys don't buy, then you've got real trouble, okay? The irony of repeating the mistake is of Germany's Reichsbank in 1918 to 23 will be completely lost in the path of escalating failure will only encourage the pace of printing to be accelerated. Now, every time you print dollars or bonds in the US government or the Australian government or whatever, you're effectively selling the currency, okay? That's what you're doing, because you keep printing and printing and printing, and there's nothing behind it. So you're effectively selling your own currency. He goes on to talk about the coronavirus. The stats are going everywhere. It's in 27 different countries at the moment. How bad is this thing going to get? And this is going to add to this bear market. Okay. Also, it says, take an example of the US bond market, because fiat currency fans believe that other than individual time values, it's the risk-free investment yardstick. The 10-year US Treasury bond yields less than 1.6, but its future price raising some serious issues, right? Now, the US bond market has a AAA according to Standard & Poor's. Standard & Poor's is in the US, but if you ask the Chinese where they see the US rating, credit rating, they have a different measure for that, and they set a lot lower than that, even though they do buy the bonds of the US government, okay? But the thing is, what he's also saying is if inflation is well above 2.5%, rightly so, then the US Treasury bond should not be at 1.6%. Now, I agree with them. In old-fashioned economics, when I was studying economics, they used to have a thing called the Taylor's Rule. And the Taylor's Rule was basically this. If inflation was running at 3% and growth domestic product was running at 3%, growth and inflation was running at 3%, then your 10-year nominal bond rate should be at 6% yield, okay? So if we said in the US that inflation's running at 4% or 5%, which is more like it, I think it's higher than that personally, and we said that growth at 1.5%, we say inflation's at 4 and growth at 1.5%, then the Taylor Rule says a 10-year nominal bond rate should be at 5.5%, and that's not the case. All right, and that's pretty much what this guy's alluding to. He's basically saying bonds have gone down. There's been a floor at 1.4%, but they're not representing the true value of where a bond is, and that's it. This is the whole point. Markets can be priced somewhere and show you where a yield is on a bond or, XRP or where the equities are, but it doesn't make it right. It doesn't, in other words, it's not sustainable because it's severely overpriced to where it's been in history or severely underpriced to where it's been in history. And it's also like these mean reversion arguments. When something is so overpriced in history, eventually it goes back to the mean, the average. Okay, so if the S&P 500 has a price earnings ratio of 25, but the average on the S&P 500 is 15, eventually over time it will go back to 15, which means it gets sold off back down to 15, which is the average of the S&P price earnings ratio. So pretty much what he's saying is with current yields of below 1.6% or 1.5, there is little upside in price, and we can understand why. Okay, he's talking about the CPI being 2.5%. The yield should be closer to 4% if you're assuming that GDP is 1.5, and I tend to believe that. He said it's been heavily suppressed at current levels, and we've seen that in the past with quantitative easing. We've seen that with more buying from the US Fed. The balance sheet bloated up to billions and billions and billions of dollars after 2008, 2009. We've just seen, this suppression of interest rate yields everywhere along the world, okay? And whether it be through, the repo market or quantitative easing or the buying of all long-term yields to keep those yields down, there has been a suppression by all central banks around the world to do that. So he's effectively saying the CPI is not where it is, and I agree with that. And he's basically saying that he brings up this two independent analysts, CHOP Index and Shadow Stats. Don't know these analysts, but I'll have a look at them. Confirm each other that a more realistic rate for monetary depreciation of the US dollar is not 2% but 10% annually, which is a bit scary. Okay, very, very scary indeed. If that's the case, bondholders that have been buying bonds in the US at 2%. If the real rate should be at 10%, that there would be massive losses if that's the case. Massive losses, right? If they have to sell before holding to maturity. Because if you sell before holding to maturity, you've got obviously a redemption price of 10% where you're going to lose 8% of the bond, right? Of the bond's capital price as well. So clearly the US Treasury market is badly priced. To estimate the likelihood of the Fed losing control of bond pricing, we should take into account the state of US government's finances because we've not yet incorporated future currency debasement risk in our calculations, right? So starting with the budget deficit and then the slump and then government finances getting worse, he's basically saying these could all be sharply revised downwards and further evidence of a looming slump becomes too hard to ignore, okay? And also, obviously the credit cycle hitting SMEs particularly hard, okay? Unemployment will rise along with bankruptcies, and this assumes little or nothing for the effect of the coronavirus. He basically says even if the coronavirus is contained for China and East Asia, Europe corporations' supply chains will cease to function, requiring both time and bank credit to relocate. Now, we've seen that with Apple already saying something about China. They're going to not meet their quarterly forecast going forward, and they told the market last week, okay? Apple still went up, but it should have actually gone down, okay? This is a very good article. So basically saying the adjustment will follow the current period of complacency. US Treasury bonds have recently risen, partly on a safe haven basis, but certainly with enduring belief in state economic management. Equities are at close to all-time highs on a relative value to bond yields argument, and an expectation that any recession will be shallow. Well, I don't believe that. I think the recession that's coming will be quite big. Further monetary easing is expected to support the economy and maintain the long-term prospects for resumption to decent economic growth. Further monitoring isn't seen to be bullish, but what happens when easing interest rates doesn't do it anymore? And we've seen it in Japan. You know, the Japanese Nikkei back in the 80s, if I remember right, it was about 40,000. You know, I don't know where the Nikkei is now, but I suspect it's under 20,000, maybe 15,000. They continue to ease rates to literally negative, and yet it did nothing to increase the growth in Japan. And that's what we could be looking at, particularly in other G7 countries like, you know, parts of Europe and also the US, okay, where interest rate reduction does nothing to create growth, does nothing. Okay, so that's pretty much what he's saying. You know, he's talking about the concerns of dollar are broadly absent, and that's true. And also saying that investors are not taking note of anything when they keep buying the equity market. Okay, and all the things are set in place, right, for this economic slump and this equity slump in markets, right? So, and then he says if the government keeps doing what they're doing, assuming the Fed is losing control of its overall monetary situation and pricing returns to being set by markets, how do you rate a very large borrower with the following credit profile? The markets will go back to incorporating risk properly, because at the moment he's basically saying the market is not incorporating risk properly. And I do agree with this, I have to say. He said other central banks are in the same boat, which they are. If you look at every other central bank, be it the UK, be it the European Central Bank, look at other countries, Japan and whatnot, it's exactly the same story. That's a fact. That's a fact indeed. I mean, you've got Germany very exposed to China, but also to Africa. You've got a lot of corporates in China, and if there's no growth in China and it's been closed down until the end of March or mid-March, that is a real concern. Basically saying in this environment, people will get out of cryptocurrency and they will go to gold, and they will also even go to Bitcoin, okay? They'll even go to cryptocurrency itself, okay? Because these two will not sell off as much, as I've said before, by fiat currency, and also they won't sell as much as per the equity market, okay? So we've seen gold move up quite a bit, and this is a chart that he's US gold price adjusted for FMQ since 1934. So what's that? Fiat money quantity. Okay, so what we have seen, is gold starting to move up quite dramatically. He says that Bitcoin is going to move up as well. It's going to probably be very similar to the movement on gold, and his conclusion is straws in the wind listen in the other point to a more rapid collapse of financial asset values and currency than generally thought by sound money theorists who have had long anticipated outcome, okay? Let me just get rid of that. To the extent the current coronavirus has had a hand in the forthcoming destruction of fiat currencies and Keynesian methodology, we take some comfort that it will have brought forward the eventual reintroduction of gold and gold standards, okay? So maybe he's talking from his own book as well, because he does work for goldmoney.com. But I do believe enough about what this fellow is saying, because I do look at economics quite a lot, and I do believe that where the interest rate market is globally is just unsustainable, and certainly where equity markets are globally, not just the US, are unsustainable. And I think there's going to be a massive switch out of those markets, out of those traditional fiat markets, certainly into cryptocurrencies. And I've always believed in that thesis. So watch out, keep an eye on things, because this market, all markets are going to get very interesting in the next, certainly from here in the next year or so. Okay, so yeah, have a look at this. If you've got any questions, please do come back to me. Please do look after yourself. Be good to yourself. Be good to your parents. Be good to your family and friends. Be good to your putty cats, your beautiful animals. Be good to the environment. I noticed that Jeff from the, what's his fellow's name, from Amazon has put $10 billion as an environment fund, which I think is super. And even Bill Gates is talking about it, which is awesome, man, awesome. So, and please just be really kind to people in the world, just to make this a better place. It's really hard for everyone. You know, life is becoming more fragile every day. Thank you all for listening. I'm Susie. Cheers, guys. Bye, guys and girls. Now let me turn this off. I always can never turn this off.